Look at the numbers on a financial trading screen. Those numbers are someone's home, someone's retirement, someone's dream. We take this for granted, but there was a moment in history when this was not yet obvious. A moment when the practice of pricing invisible things stopped being a technique and became common sense. The raw material that day was not gold, not oil, not railroads. It was a flower. At this very moment, the notional value of contracts trading across global derivatives markets exceeds $800 trillion. Futures, options, and countless instruments stacked on top. A vast system where agreed-upon prices trade without physical goods ever changing hands. Trace the popular origins of this system to its roots, and we arrive at 17th century Dutch soil. To price a bulb buried in the soil, people began anchoring the invisible to paper. That paper survived 400 years. The flower wilted. The contract endured. In the mid-16th century, Ogier de Busbecq, Ottoman ambassador turned European envoy, packed an unfamiliar bundle of seeds on his journey home from Istanbul. A flower that filled the imperial gardens of Ottoman sultans, carved into tiles by rulers, invoked in prayers to God by poets. It crossed westward. In 1593, botanist Carolus Clusius planted tulips in the botanical garden at the University of Leiden. They survived the Dutch climate, at first rare specimens circulating among scholars. But Clusius refused to sell the bulbs. He monopolized them for research. Someone broke into the garden and stole them. That theft was the birth of the Dutch tulip market. From there, the tulip slowly ascended, a luxury signal of wealth and status among the elite. The problem was biological. A tulip bulb planted in October blooms the following spring. Through winter, the bulb remains buried, a flower not yet open. Something that cannot be confirmed with the eye. Pricing the invisible required a promise. This spring, I will deliver the bulb buried in my garden at this price. People began selling spring in advance. Before the flower opened, they fixed its price. Paper moved first. This was a futures contract. This was a derivatives trade. The first scene of pricing the invisible descending into the crowd. But this era held another secret in the Netherlands. Some tulips suddenly transformed. Solid colored petals erupted into flame-like streaks. Red and white intertwined in patterns that resembled fire consuming itself. No one knew the cause. Some said pigeon droppings. Others blamed poor soil. One man spread lime. Another mixed paint into the earth. No one was right. Then in 1928, the cause finally began to reveal itself in the laboratory of plant pathologist Dorothy Cayley. Those beautiful streaks were a virus carried by aphids. The flame that humanity had worshipped was not a miracle, it was a disease. The source of beauty was the source of ruin. A bulb infected with the virus shrank a little more each year. It produced weaker offsets. Eventually, it lost the strength to bloom at all, and died. The bulb someone traded for a house was terminal from birth. No one knew. The more intricate the stripe, the more erratic the pattern, the higher the price climbed. Because it was rare, because it could not be replicated. The market called it perfection. It was cellular decay. In the early 1630s, the Netherlands was the wealthiest nation on earth. Its East India Company commanded the Asian trade routes. Amsterdam was the financial center of Europe. A currency crisis in the 1620s had been survived. Prosperity followed. The Black Death had thinned the labor supply. Real wages surged. The market overflowed with surplus capital. The money had nowhere to go. capital found an exit. It found tulips. Wealthy merchants entered first. They bought rare varieties, tended their gardens, displayed their wealth. Then the middle class followed. In 1636, the market's structure shifted. Not on the official Amsterdam exchange, in taverns scattered across the city. Merchants formed clubs called colleges. They chalked prices on slate boards. They drank. They priced bulbs still buried in the earth. Amsterdam, Haarlem. Each city's tavern ran independently. The only communication? Horses and boots. Prices did not sink between cities. The same variety crossed a city line and traded at a different price. Those who noticed the gap entered. They came for the spread. This system had no margin requirement, no collateral, no exchange guarantee. Thousands of guilders rested on personal credit, on reputation alone. Each completed trade cost one thing: a round of drinks. Then a decisive structure emerged. Contracts traded without the physical bulb. Someone who had never held the bulb bought a contract in the morning and sold it by nightfall. The Dutch had a name for it. They coined it themselves: windhandel, wind trade. The wind spun faster. Between winter 1636 and early 1637, a single contract on a common tulip variety changed hands 5 times a day, 10 times a day. The bulb stayed in the ground. Only paper moved. Paper traded faster than bulbs. Paper traded more than bulbs. The common variety switchers traded at 125 guilders per pound in late December 1636. 1 month later, early February 1637, the same variety, 1,500 guilders, 12 times the price, 1 month. Witte Kronen surged 26 times in January 1637 alone. By the first week of February, it had fallen to 1/20th of its peak. This is not the story of a rare exotic variety. This is the story of ordinary bulbs. Where did the price come from? Not from inside the bulb, not from the soil. The price lived in people's minds. As long as everyone believed the next buyer would pay more, the price rose. There is evidence of how far that belief reached. The most prized variety of the era? Semper Augustus. White petals, crimson flame etched across them. A single bulb of this variety reached 6,000 guilders in early 1637. A skilled craftsman saving every guilder for 20 years could not afford it. It was the price of a luxury canal house on the Amsterdam waterfront. The exchange for a single Viceroy bulb is on record: 2 loads of wheat, 4 loads of rye, 4 fat oxen, 8 fat pigs, 12 fat sheep, 2 hogsheads of wine, 4 barrels of beer, 2 tons of butter, 1,000 pounds of cheese, a bed set, a suit of clothes, a silver drinking cup. Everything combined, 2,500 guilders, exchanged for 1 bulb. It was not simply a flower. Enough real-world wealth to feed a city for a period of time had been exchanged for something buried in dirt. This was not an exception. This was the market. In the summer of 1633, a house in the city of Hoorn traded for 3 tulip bulbs. That same year, a farm in Friesland changed hands for a handful of bulbs. The real estate market and the tulip market had merged. There is a scene more vivid than any number. A sailor from an East India Company vessel arrived at port and entered a merchant's warehouse. The merchant, grateful for good news, offered the sailor a herring for breakfast. The sailor went looking for an onion to go with it. Between bolts of fine silk, he found a bulb. He pocketed it, sat on a coil of rope, ate it with his herring. By the time the merchant had torn through the warehouse and sprinted to the dock, The sailor was swallowing the last piece. What you just ate could have fed 20 sailors for a full year. The sailor went to prison for 6 months. What he had eaten was a Semper Augustus. In his eyes, an onion. In the merchant's eyes, a mansion. The price was not inside the object, it lived in the eye of the beholder. Another record. A weaver. He heard that tulip bulbs multiplied on their own, produced offsets, grew in number, and the prices never stopped climbing. He sold his loom. He mortgaged his house. He exchanged every tool of his livelihood for bulbs. His logic was this: no need to weave cloth anymore. Bulbs multiplied faster. Bulbs multiplied more. He believed he was a genius. The loom was obsolete. January 1637. Alkmaar. A large auction to settle the estate of a deceased tavern owner. Wealthy dealers arrived from across the country. Total bids for the day? 90,000 guilders. The lifetime wealth of the era's most successful merchant, traded in a single day. But many in that auction room read a different signal. The price had just hit its historical peak. It could not go higher. Fear began to sprout. The paradox was in motion. The highest price was the strongest sell signal. At the same time, bulbs planted in November 1636 were pushing sprouts above ground in the first week of February. Far more had been planted than anticipated. The fear of oversupply became reality. The first Tuesday of February 1637. A tavern in Haarlem. A merchant opened an auction, same as any other day. A contract for common tulip variety, offered at 1,250 guilders. No one raised a hand. The auctioneer dropped to 1,100 guilders. Still silence. 1,000 guilders. Silence. That silence ended everything. Panic spread. Not a domino, a mirror shattering. One crack and the whole surface broke apart. Speculators threw down their contracts at once. No one bought. Within days, what had been worth a house on that Tuesday was worth a bundle of onions. The bulb had not changed. It was still in the ground. What changed was inside people's minds. When the belief vanished, the price vanished with it. The contracts became worthless paper. Buyers refused to pay, all at once. Bulbs contracted at thousands of guilders were now worth tens of guilders. To honor the contract was to lose everything. They refused. The sellers, the growers, were left holding the collapsed bulbs. They went to court to recover their debts, but the judges knew. These contracts had not been formed on an official exchange. They were off-market agreements, struck in taverns, without collateral. The court refused to rule. It sent the disputes down to individual cities. May 1638. Haarlem City Council announced a settlement. Buyers could legally void all contracts by paying just 3.5% of the original contract price as a penalty. A 5,000 guilder contract settled for 175 guilders. Growers kept the bulbs. The majority of the loss was theirs to bear. The intent behind this decision was not fairness. It was containment. Stop the credit crisis from spreading into the real economy. Prevent the gambling debts of taverns from shaking the foundations of a trade empire. On that objective, the measure succeeded. Economic historian Anne Goldgar went through every court record and notarial document from 17th century Netherlands. Her conclusion was unambiguous. No individual directly bankrupted by the tulip mania appears in the records. The image drawn by Mackay, a nation seized by madness, cast into the streets, was an exaggeration. Sourced from satirical pamphlets written by moralist clergymen of the time. The majority of those who participated in the market were not the poor. Wealthy merchants, skilled artisans, brewery owners, members of parliament. Only those whose identity could be verified were admitted to the credit-based tavern trade. The entry barrier was high. The real damage was not economic collapse. It was the collapse of reputation. Dense networks of trust, woven through families, neighbors, religious communities. Inside those networks, contracts were broken. Debts were evaded. That was what truly shocked the people of the time. The Dutch real economy did not waver. The East India Company kept sailing to Asia. Amsterdam's financial dominance held through the entire 17th century. The legend was larger than the reality. But the legend left something behind. Look at who remained when the speculators left. Look at what they left standing in the wreckage. That is the real conclusion of this story. The first survivors, the professional growers. Speculators had wanted the bulbs, growers had owned the skill. When the mania ended, the market overflowed with bulbs. The skill remained. Speculative capital had produced one thing of lasting value: the heat of variety development. Experiments in cultivating rarer stripes. What those experiments left behind? Cultivation know-how, storage technology, a logistics system. The Growers Guild reorganized the market. They standardized varieties. A tulip catalog published in 1637 became the reference for all trades. No longer verbal agreements in taverns, transparent trades based on a verified list. A mechanism for price discovery was born. The same flower took a different path in the Ottoman Empire, the tulip era of Sultan Ahmed III. Each spring, millions of blooms were planted in the palace gardens of Istanbul. Petals were tied with thread so they would not open too wide. Candles were strapped to the backs of tortoises, and the tortoises were set to wander between the flower beds. Candlelight reflecting off silver name tags, a spectacle of light. But the Ottoman Empire controlled the price. The trading ceiling for rare varieties was set by royal decree. Merchants who violated the regulation were expelled from the city. It was not market-permitted madness that built a system. It was court-enforced order that prevented one from forming. The same flower. In one place, the ancestor of modern finance. In the other, a tile pattern. The tulips carved into Ottoman Iznik tiles were beautiful. They stayed on tiles. In Arabic script, the word for tulip, lale, and the word for God, Allah, are composed of identical letters. In Islamic numerology, both words carry the same value, 66. To the Ottomans, the tulip was a manifestation of the divine. The sacred could not be traded. That was what split this flower into two destinies. The second survivor. The trading system itself. The structure that evolved from tulip futures contracts left the tavern behind. It moved into maritime trade. East India Company ships sailed to Asia. They could sink in storms. They could be stripped by pirates. A single voyage staked what would be hundreds of thousands of dollars today. How do you manage that uncertainty? Early VOC share trading was extremely inefficient. To buy or sell a share, both buyer and seller had to appear in person at the Amsterdam headquarters of the East India Company. Sign before the bookkeeper. Pay the fee. Wait for the transfer to be approved. Capital was locked up for extended periods. The merchants had a familiar solution. The logic of the tulip futures market was transplanted. A contract that agreed on a future price without physical goods. A netting system where only the difference in price was exchanged in cash on a set settlement date. This was a single technique born in 17th century Amsterdam taverns. Sell the future, settle the difference. That habit was later formalized into the order of clearing and settlement. The tools of wind trade became weapons of risk management for a trade empire. In 1688, Joseph de la Vega documented the Amsterdam Stock Exchange. The merchants of the time already used call options and put options as everyday tools. They applied daily settlement techniques. They knew how to extend contract maturities. The grammar of modern derivatives trading already existed in the Amsterdam Exchange of the 17th century. The third survivor, Aalsmeer. In 1911, Dutch flower growers built a cooperative auction house instead of a tavern. Transparent price discovery, no information asymmetry. The Aalsmeer flower auction, merged in 1968, expanded until it became the world's largest commercial building under one roof, covering the area of 165 football fields. Today, Royal Flora Holland. Billions of flowers and plants traded through this platform each year. The Netherlands controls more than half of global flower exports. The descendants of bulbs that became worthless 400 years ago are being traded on the auction clock right now. Even the structure of that auction clock is a 17th century inheritance. Starting high, dropping the price. The first to press the button wins. Extreme efficiency. Flowers traded in seconds because freshness is everything. The slate board of the tavern became a digital cloud platform. The legend must be reassessed. The tulip mania was not a collective madness that bankrupted an entire nation. It was a credit experiment among the wealthy merchant class, one that reached its structural limit. The macroeconomy did not collapse. But there is something more important than the legend. The system the legend left behind. That was real. The collapse of the Dutch economy was a myth, but the financial infrastructure that grew from that myth was real. The tulip died. The contract survived. A single sheet of paper, invented to price a bulb buried in soil. That paper became stock. It became bonds. It became futures. It became the numbers on the screen. The form changed. The structure did not. Price is not inside the physical object. Price is inside belief. The moment belief disappears, a house reverts to a bundle of onions. As long as belief holds, the numbers on the screen are our home, our retirement, our dream. The greed is gone. The madness is over. The weaver's loom never came back. But the tavern's contract lives and moves in the servers of exchanges across the world. This is the world that greed built.